Thank you all for joining me. I'm going to start by speaking briefly about the broader global economic context from the viewpoint of our clients, the emerging markets. And as we all know, uncertainty and volatility are undoubtedly contributing to a more cautious economic and business environment. I think that's going to affect how governments and businesses make their investment decisions right now. But meanwhile, interestingly, developing economies are playing a far more central role in global trade than they did, say, 2 decades ago. And in that time, global trade has nearly quadrupled in nominal terms, and the share of the developing countries in that trade has nearly doubled from about a fifth to almost 2/5. And again, half of their exports now go to other developing countries. At time back in 2000, that was just 1/4. I think this shift brings both an opportunity and exposure. Countries with export-led growth models, particularly those reliant on commodities or manufactured goods, they're much more vulnerable to disruption. But they also have policy levers to help manage the uncertainty and position themselves for a longer-term resilience. So to give you an example, many developing economies still maintain higher tariffs than advanced economies. On the average, several percentage points higher on key imports. I think that creates a real risk of reciprocal tariffs and, most importantly, lost competitiveness. So a broad-based liberalization, not just with favored partners, can help offset these risks and actually expand market access. And history shows that more open economies tend to grow faster and they withstand shocks more effectively. Second, there is untapped potential in deeper regional integration. Trade among developing economies is growing rapidly. Nearly half of exports from these countries, as I said, now go to other emerging markets. Strengthening regional ties through more efficient border processes, lower trade costs, less friction, clear rules of origin, these can boost trade volumes and support more stable and diversified growth. The point is, these aren't abstract principles. They're practical strategies, and they could be done with these countries. We know that development is a long-term endeavor. It's not always linear, but history does show that progress is still possible even during periods of disruption. And while I don't yet know how this uncertainty will impact global growth, what we are seriously thinking through is our toolbox, drawing upon our prior experiences, for example, with COVID or the 2008-09 financial crisis. In partnership with the IMF, with our local presence, global reach, and through our financing, technical support, and infrastructure, I think we can help enable both domestic productivity and international trade for some of these emerging markets. So that's the broader context. Now let me take a few minutes to talk about the World Bank Group itself, what makes it uniquely valuable, how it works, and how we're evolving in our current context. So I'll start with the basics. How the bank is structured, why that matters. I'm going to walk through our financial model, and from there, I'm going to go to the reforms we've made to move faster and to do more. And then I'm going to focus on jobs and what to expect at the spring meetings next week. And I'm going to close with some news about the next phase of the private sector lab. The World Bank was not born of altruism, but of strategic design. It was meant to help forge a more stable, prosperous world, where economies could grow, conflict could be avoided, and private capital could find new frontiers. This wasn't charity. It was a calculated investment in the global economic architecture, one that I believe has paid off many times over in these 80 years. But today, the questions we hear in both developed and developing countries are remarkably similar. What does the future look like here? Why should we invest in it? And those are fair questions. Some of you may have similar questions. So let me talk about that for just a minute. Let's start by walking you through the structure of the bank. It really is unlike any other institution in the development landscape. The World Bank Group is made up of 5 arms that operate as one integrated platform. The International Bank for Reconstruction and Development, IBRD, which lends to middle-income and creditworthy low-income countries. It finances infrastructure, roads, schools, hospitals, energy, things like that. Then there's the International Development Association, IDA, which supports the world's poorest countries with a combination of grants and low-interest loans. It helps places that cannot access capital markets, that they can invest in the basics of development. So over time, 36 IDA countries like South Korea, India, and Turkey, these have grown and they've graduated from being IDA recipients. Then there's the International Finance Corporation, IFC, which invests directly in private businesses, particularly in challenging sectors and regions. The idea there is to mobilize private capital to create jobs and support entrepreneurship. Then there's the Multilateral Investment Guarantee Agency, MIGA, which provides political risk insurance. It protects investors from threats like expropriation, conflict, and currency restrictions. And the last one is the International Center for the Settlement of Investment Disputes, ICSID, which offers legal protection by resolving disputes between investors and sovereigns and governments, reinforcing the rule of law and investment confidence. There's no other institution that brings all of this together in one place, and that's what makes the World Bank Group uniquely positioned to support countries and investors across the entire development journey. And because we try and operate this as a system, I think we can work to deliver development finance at scale far beyond what any single entity could do alone. Now, the model isn't just powerful in terms of the volume it can put to work, it's efficient. Because over the past 80 years, $29 billion in shareholder capital that has been contributed to IBRD, IFC, and MIGA has mobilized $1.6 trillion in development finance. That's 50 to 1. In the last fiscal year, 24 alone, we deployed $133 billion. Now, IDA works differently, powerfully, but differently. Every dollar contributed typically delivers $4 in financing for IDA. The bank's financial strength is also sound. IBRD and IDA have never written off a loan. Administrative costs, salaries, travel, real estate, etc. are covered by income from repayments and investments, not from donor dollars. And we made steady progress on internal efficiency. We brought our operating costs down to just under 50% of earnings from just under 70% a couple of years ago. Now, having a strong model is not enough. And to meet today's challenges, migration surges, youth unemployment, and growing fragility, we've had to become faster, more responsive, more focused. And that's what the past 2 years of reform have been about. We've cut project approval times by 26%, from 19 months to 14, with a target of 12 months by this June. Some projects, by the way, are now approved in under 30 days. We've streamlined operations. We've combined over 40 country offices. We're launching new tools to help governments prepare bankable projects faster. We've cut duplication. We've launched a joint platform across the multilateral development banks that has grown from 74 to over 170 pipeline projects in a year. 10 projects have already secured full financing through this portal, totaling $14 billion of financing. We're turning to results. We're focusing our corporate scorecard on 22 real impact metrics instead of what was earlier 158 input process indicators. We've expanded our balance sheet. We've added $150 billion in lending capacity through hybrid capital, equity to loan ratio changes, and new instruments like 50-year loans and rate buydowns. But the thing is that reform alone is not enough. And to deliver opportunity at scale, what we need was a sharper focus. That's why we've made job creation the centerpiece of our agenda. You've heard me speak about this for quite a few months now, but over the next decade, 1.2 billion young people will enter the workforce in developing countries. Currently, the forecast is for those countries to deliver 420 million jobs. And that gap is not just an economic issue. I think it's a global risk because without opportunity, the forces of fragility, of illegal migration, of instability, these forces grow stronger. So if you're interested in understanding the situation in your specific country or region, I'm sure we can get you information specific to that country or that region. We're taking basically a practical three-part approach. Our public sector arms, that's IBRD and IDA, they work with governments to lay the foundation, to deploy finance towards infrastructure, education, healthcare, food security. These are the essential conditions, the enabling infrastructure for people and businesses to thrive. Our Knowledge Bank helps to create the right environment by supporting regulatory and policy reforms, building on that infrastructure, improving governance, and linking financing to results. So in 2024, Nearly half of our public sector financing was performance-based, linked to results, up from 28% a decade ago. And finally, through our private sector arms, IFC and MEGA, we can help to mobilize investment, provide financing and risk and mitigation, and support business growth in areas like energy and infrastructure, agribusiness, healthcare, tourism, manufacturing. These are sectors that create large numbers of jobs, and all of these are backstopped by ICSID's capabilities in settling disputes. This jobs-focused strategy was the motivation behind the Jobs Council that President Tharman of Singapore and former President Michelle Bachelet of Chile are leading. This is at the heart of our spring meetings next week because it reflects both our urgency and our conviction that development must lead to opportunity. We've also had to confront a hard truth, which is the private capital part of the story. The private capital that over the years, people have spoken of the billions to trillions. That era did not show up in the scale everybody hoped. It wasn't because the money didn't exist. It's because the conditions weren't right for that money to be employed for the purposes we wanted. Too often, regulatory uncertainty, currency risk, and political instability kept investors on the sidelines. So I think what we're trying to do is a different approach. As you know, we launched the Private Sector Investment Lab a little while after I started with 15 odd CEOs from across the global economy. We've approached it like a scientific method, figure out the barriers, hypothesize possible solutions, and then test what works. And we've come to 5 core areas that we're focused on. And the first one is regulatory and policy certainty. Help governments set clear, stable rules to attract long-term investment. This is the one we're testing through our M300, our effort to connect 300 million people in Africa to electricity by 2030. Second one is political risk insurance. We're applying that by streamlining our guarantees. Early returns are encouraging with a 30% increase in issuance already. I think that puts us on course to beat our goal of tripling the business by 2030. Third pillar is foreign currency risk. And to figure out how to handle this, we're expanding local currency financing and also to help strengthen capital markets, local markets. Over the 5 years, IFC has committed over 19 billion in local currency loans. Nearly 1/3 of it is long-term financing and a 20% increase over the period. But our real goal is to get to 40% of our financing being local currency by 2030. A fourth pillar is junior equity capital. And so for that, we've launched the Frontier Opportunities Fund to take early stage risk and to catalyze investment in underserved markets. So we seeded that with IFC's retained earnings, but the fund will hopefully scale with support from donors and philanthropic partners. And then the final pillar is securitization. We're working with institutional investors like Standard & Poor's and BlackRock and other pension funds to create standardized investable loan packages, unlocking capital from these pension funds and sovereign wealth funds. Thing is now we're ready to scale, and at the spring meetings, you're going to hear the next phase of this private sector lab. We're going to expand its membership to include the sectors that we believe are most critical to job creation. And these are energy and infrastructure, agribusiness, healthcare, tourism, and manufacturing. We're moving from testing to implementation. This work is being mainstreamed across our operations. We're tying it directly to our jobs agenda that is at the core of our strategy. I think that could be a big step forward for the bank. In an era of fiscal constraints and strategic uncertainty, I continue to believe that the World Bank Group is a smart investment for governments, for taxpayers, and the private sector to partner with. We're on the move. We're trying to change things here and look to deploy proven tools to unlock growth, to reduce fragility, and generate returns for people, for businesses, and for the global economy. And the idea is build a bank that delivers what is demanded, jobs, because jobs is the best way to drive a nail in the coffin of poverty. Happy to take your questions. Thank you.
Thanks very much, Ajay. And as a reminder to attendees, if you can please click the raise hand button on your screen, we'll be able to call on you. Thanks very much. And I see first top of screen is Andrea Shalal of Reuters. Andrea, go ahead.
Hi, thanks so much for taking my question. Great to see you both. Ajay, I want to ask you about the outlook that you've presented. So this dampening of investment, the uncertainty, there's a lot of people talking about a paralysis. How do you anticipate, what do you see the trajectory for that? Do you think that gets resolved in a matter of months? Is it in a matter of weeks? Or are we talking about perhaps a year or two while the global economy adjusts to the new reality posed by the reciprocal tariffs being imposed by Trump, and then the the retaliatory measures that we're seeing?
So, Andrea, thanks. I don't know how to predict the timeline, because what I don't know is how quickly you get to resolution on some of these specific country by country negotiations. The one thing I would say is really important is countries need to care about negotiating and dialogue. It's going to be really important in this phase. And the quicker we do it, the better that'll be. And the second part is work with the willing partners that you can work with to keep your regional and bilateral trade deals going as well, because both are going to be important. The issue of paralysis, and the time frame it takes. Look, when I was a CEO just a couple of years back, I know that I made investment decisions based on 10, 15, 20-year thinking. That's not to be idealistic. There's almost every country that I invested in where what I thought I was investing in a set of assumptions with would probably change somewhere in that time frame. So this is not idealism, but predictability and consistency kind of grease the skids for a private sector enterprise to think about how to invest for the longer term. If you lose that predictability, that causes some degree of paralysis and uncertainty. That's the part I don't know how to predict how long it takes to get out, because most of this is caused by the current discussion on trade. If we get to good resolutions through that negotiation that I'm encouraging, through that dialogue that I started with, then I think you could get past this relatively quickly.
Can I just follow up real quickly? I'm so sorry. Is that possible?
Go ahead.
I'm sorry. Just the amount of money that's available to developing countries is vastly reduced now because the US was such a large provider of foreign aid. How do you see that affecting those countries? I mean, regardless of the trade discussion, just the actual physical, amount of aid.
Yeah. Just so you put the whole thing in context, aid is really not going to be the solution for development in these countries. Aid is a temporary method to help the countries that are really challenged find a way past it. So in the context of the total dollars required, Andrea, the reduction in aid, not just by the US, other countries, including European countries, are speaking to a reduction in their overseas development assistance because of other fiscal priorities. If you go back in time, and you and I met a year and a half ago as well, I've talked about the issue of fiscal challenges across the world. To believe that even the richest countries can continue to fund ways that will be contributing to development elsewhere through aid is not a good strategy. Hope is not a strategy. And that's why I've been saying for a while, we have to think about creating the right construct and system to get the private sector in. Because that's the only place where consistent sums of money, large sums of money, with the technology and the innovation and the ingenuity of the private sector can come to play in the development world. It doesn't work in every aspect of development. It works where the private sector feels it can see a pathway to a return. And that's what I was laying out. Build the enabling infrastructure, help to create the right regulatory framework, a land law, labor law, mobile collateral law, bankruptcy law, things of that nature, and then help to bring the private sector, small, medium, large, global, local, small farmers and others into the system to help create the virtual flywheel of job generation. To me, that topic is the core of development, because jobs are the way that will get countries to move forward. That's the way that poverty has been fought for the past 30, 40 years, through the creation of jobs. And that's what I'm speaking to.
Thanks very much. We see next Daniel Avist. Daniel, go ahead.
Hello, can you hear me?
Yes.
Oh, fantastic. Thanks so much for taking my question. Just a very quick question. How have the priorities of the bank, your priorities, changed since the change of administration in the United States? do you expect to make any changes to your priorities going forward? For example, do you expect any changes to the World Bank Group's commitment to, hitting that 45% climate finance target? Thank you.
Thanks for the question. So let me just put something in context for you, so you get the idea that this is not about one administration. In the past 8 months, 9 months, during the IDA replenishment cycle, my largest shareholders have had enormous government turnover. Japan, Korea, Canada, Germany, France, the UK, Netherlands, Austria, and now the US as well. These are all my largest shareholders. And we've had to go through that process with them. Each time they ask the right question. It's our government, we're new in government, help us understand, why are we in this with you? And I think that's perfectly logical, and I'm willing to engage with that discussion each and every time. Your specific question about climate finance. The words might be a problem in different people's eyes, but when you unpeel the onion of what's inside the 45% that we committed to, we are not taking away from education and schools and development to fund something. What's inside the 45 is a commitment that half of it over time will go to resiliency and adaptation. That's a school roof painted white instead of red, so it's cooler inside. It's a school that doesn't get taken away in a hurricane, or a road that gets washed away in a monsoon, or it's heat-resistant varieties of seeds, and it's drip irrigation. Those are things that are relevant in development. It's smart development. The other half is meant to aim for mitigation. And that's when people think, oh, that's all about energy. It's really not. The largest parts of mitigation are a railroad in the Lobito corridor to help move produce and minerals and metals, rather than through truck, through rail, which is way more climate friendly. Or a bus rapid transit system instead of individuals going in cars to work. It also includes energy. 5% of our total financing, that's 5 out of the 45, 5 out of the 100, goes to energy. A percentage of that goes to gas as well. And I've publicly said we have a meeting with our board in June, and I want to discuss how to talk about the all of the above strategy in energy, which is not just renewable energy, but a transition plan for everyone. There is no reason why a country in Africa should not care about affordable, accessible electricity. It's what we are trying to do with the efforts we're putting in. And it includes gas, geothermal, hydroelectric, solar, wind, and nuclear where it makes sense. That's the strategy we're going to discuss with our board. We have to get board approval. We have to get shareholder approval. I don't know if that'll change what I do. It'll depend on the approval I get or not get in the coming period.
Thanks very much. And let's turn now to David Lynch, please. Thank you.
Okay. Good morning. It occurs to me that multilateral institutions like the World Bank are pretty much exactly what Donald Trump hates about the modern world. So just very directly, how confident are you that the U.S. is going to remain an active and financially supportive participant in World Bank affairs going forward? Thanks.
Thank you, David. I mean, look, at the end of the day, we're in active conversations with that government as well. And so we've had very constructive discussions about what is it about the World Bank Group that should interest, as I said, each of these countries, including the US. The difference between what you would call multilateral institutions overall and us, first of all, remember, the US is a 17% shareholder in our institution, and they contribute capital, as I said, to IFC, IBRD, and MEGA. And if you look at that capital contributed, it's just under $5 billion over the past many years. We don't take donor funding for our expenses. Where we do take annual funding from taxpayers, and therefore the donors of these countries, is for IDA. I don't yet know what the US will contribute to this last round of IDA. That uncertainty is real for the World Bank Group and our recipients. When we had originally completed the round of pledging last year in December, we were adding up, including leverage through the bond markets, to about $100 billion envelope available for IDA over the coming 3 years. if the US were to not contribute, and we have, remember, some European countries going through a rethink of their IDA as well, let's assume we come down to a lower number, and I'm just giving you a number off the top of my head, 85 billion. To put that in context, in 2018, the total IDA envelope was 30 billion. So we'll still have a substantially higher envelope than we used to have 5 years ago. And I'd like to think about us putting that money to the best possible use while working with every government to see if they'll continue to put in the kind of money we'd like to raise for these countries. That's how I think about it. In general, back to your specific question, we're having a constructive dialogue with the US administration. I don't know where it'll end, but I've got no problem with the dialogue I'm having. They're asking the right questions, and we're trying to give them the right answers.
Thanks very much. And I see Bukola Arolambo from Nigeria. Bukola, go ahead.
Good afternoon. Thank you very much for taking my question. I just wanted to ask, with the current disruptions in the global economy due to the tariff wars, are there chances that we'll be seeing a revision of growth projections, particularly for emerging economies in sub-Saharan Africa, and especially for Nigeria? Thank you very much.
I'm sorry. Your voice came in and out to me. Would you mind repeating the question? I'm so sorry.
Okay, thank you very much. Can you hear me now?
I can hear you, yes, thank you.
Okay, I said with the current disruptions in the global economy due to the tariff wars, are we seeing any kind of revision in growth projections for emerging economies in sub-Saharan Africa, particularly Nigeria? And if there will be revisions, what are your growth projections so far? Thank you very much.
Yeah, thank you. I think that goes back to the earlier part of the conversation. Definitely there's uncertainty and volatility. When you get that, you will get reductions in global growth. I think the impact on different countries will be different. It's a little difficult to predict exactly where that'll go country by country right now, because, for example, if you're exposed to commodity exports, and if the prices of commodities come down because of a reduction in global growth, then you will have a challenge with the budget of that country. On the other hand, if you're a smaller emerging market or a market that isn't as well integrated into the system, or your domestic consumption is a higher percentage of your GDP than your exports, and therefore different balance of growth in your country, then it's a different impact. We're kind of going to have to work our way through that over the coming weeks, depending on how this uncertainty plays out. But overall, for the global economy, certainly uncertainty will lead to a slower growth than it was a few months ago. That's for sure.
Thank you very much. Looking next to Erwan Lucas, please. Erwan, we can't hear you. Try again. Sorry, Erwan. We're not getting any audio for you, so I'm going to turn to Anita Hauser.
Can you hear me? Great.
Yeah, can hear you.
Thank you so much. I just wanted to go back to the climate question. You were saying words might be a problem in different people's eyes. Does that suggest that you're having to change some of the language around how you talk about climate in the current sort of political context? Thank you.
Thank you, Anita. No, look, as yet I haven't changed anything about, I'm still using the word climate finance for the 45%. Remember, we have a board which has representatives of all our shareholders, and all these words and thinking go through their system. This is a fair debate to have at the board, and then we'll figure out what may change or not change. But what I was trying to explain in my answer was that I'm not so concerned first about the language. I am concerned about making sure that there is clarity about what's inside the 45%. It's basically development done smart. And it includes what I was explaining about resiliency and mitigation, and it includes a new energy strategy, which we hopefully will have clarity on in the next month or two. That's kind of what I was focused on. Thank you very much. And we have time for one last question, I think.
Let's turn to Philip Inman, please.
Hi, can you hear me?
Yes, Philip.
Philip Inman from the Guardian newspaper. I was wondering, are you explicitly asking those countries, developing countries with high tariffs, to lower them? Has the World Bank ever asked countries with high tariffs to lower them in the past? And is that a reaction to what has gone on since February?
Yeah.
Was standing
Yeah.
wish
I
of
think,
yours?
Philip, if you were to talk to our chief economist, you would hear that he would tell you for a long time he's written about the fact that higher tariffs in general create friction, which leads to lower transparency and growth. This is not a new discussion. Our word on trade and tariffs is not the one that necessarily carries the most weight in a country where that's not the primary focus of our development. Our focus of our development, as you've heard, is in the past it was around the inputs into development. I'm trying to change it to the outcomes, and that has to do with the jobs that we can create and the role of the private sector. Again, something you've heard me say from the day I came to the bank. And I'm just focused on that. I'm not trying to spin this any other way. I'm just focused on a very simple reality. If you want to get the demographic dividend of the developing world to be a real dividend for all of us, then we need to find a way to create productive opportunities for that demographic bulge as it comes through the system. That's going to need the right investment in infrastructure, which enables it, the right regulations and policies, and the right situation for the private sector to be able to bring its financing to play. Without that, it's very hard to see how this demographic bulge remains a productive demographic dividend for all of us. That's where we're going. Trade is one portion of that. Trade done a traditional way, where you only outsource a job from the Western world, is one type. When you look at the 5 areas that we were speaking to, they're all areas that create jobs that are relevant in the country, whether it's the building of infrastructure, both the construction, but what it enables, whether it's focusing on agriculture, particularly smallholder farmers as a business. You've seen us announce both the $300 million for electricity and the focus on smallholder farmers with the $9 billion a year commitment that we talked about back in the October meetings, or whether it's primary healthcare, not just the delivery of healthcare, but the jobs you create for nurses and medical diagnostic technicians and PPE manufacturing. You've seen us announce that we will focus on 1.5 billion people getting access to primary healthcare by 2030, and that was announced quite a few months ago. Or the focus on tourism, where we don't have as good a role to play because we're not tourism experts, but we can help in creating the skilling institutes that connect to the kind of skills that tourism will create as jobs and entrepreneurial opportunities, or whether it's manufacturing, both for local consumption, but also for regional and bilateral trade, which you've heard me speak to at the beginning, as a good way for countries to engage in trade with willing partners. You know that in the past 15, 20 years, the number of regional and bilateral deals being signed in trade have gone up quite dramatically. This is not a new development, and you should take advantage of that as we move forward. All that is what we're focused on. A lot of those are local jobs, locally relevant, that make a difference to those countries. That's our job strategy. That's what the Jobs Council is focused on, and that's what we're trying to build with the private sector work we're doing into our strategy going forward.
Thanks very much. This concludes our press conference on the subject of jobs, though, since we'll be seeing some of you next week. I hope you can tune in or attend in person our Tuesday, April 22nd event, Jobs, the Path to Prosperity. We will have Ajay there, as well as President Tharman, Michelle Bachelet, and a number of others. Again, that's Tuesday, April 22nd, 2 p.m. here in DC. And thank you all for attending. We'll see you all next week.
Thank you.